Good afternoon, good evening, and good morning, depending whatever time frame you guys are. My name is Naeem Aslam. I work as a Chief Market Analyst at Evertrade, and welcome to our weekly masterclass. And in today's segment, the topic is masterclass on how to trade indices. Now, folks, thank you so much for taking the time out. A little bit about myself. I work as a head of market analysis at Evertrade. The full analysis that you do, all of the analysis that you guys read on a daily basis is done by myself, whether it is on our blog site, which is evertrade.com, or whether you are looking on our YouTube channel. So those videos, they are all done by myself. I come from institutional background. I have done before I joined Evertrade, I used to be at Bank of New York Mellon as a hedge fund trader. I've also worked with Bank of America in equity trading, and after that, I've had the research for several other companies. So over this span of nearly 15 years, I do have extensive knowledge of trading, and I have seen few of the market crashes, if not more, during this period. And during this year in March, when the market kind of crashed, it was literally just a replay of the previous crashes that we've experienced. So, it was very familiar sort of a situation for me with that respect. Now, that's a little bit about myself, and now it is time for me to ask you guys a bit about you. So please, in a series of a few questions, I'm going to ask you a few things. So the first one is that, have you attended any of my previous webinars? So you can say yes or no if you are there. Okay. All right. Okay. All right. That's good to know. That's good to know. All right. So out of the last, so how many of you have been trading, let's say, under a year? Basically, what this does is this helps me to fine tune my strategy with you guys, so that you guys can, so that I don't use very complex jargon, so that you guys can really understand what really I am talking about. Okay, that's good, that's good. So, and now please say yes if you have been trading for over 2 years. All right, okay, so we have a bit of a mix of a crowd once again, as always, shall we say. With some traders, they are completely newbies, and some of them, they have been trading for a while, so they will understand more than basic knowledge of financial trading. So what I will do is I will try to gather everyone together on this one. So now, before we do anything else, it is important for me to go through this slide of disclaimers and responding. So anything which will be discussed in this particular webinar cannot be perceived as an advice. If you are seeking for one, please do consider consulting with your own financial advisors. A full disclaimer is right in front of you. Now, folks, as always, I cannot stress enough the importance of you guys being on Twitter, and then why Twitter is so important. The reason is that if you are trading Forex, if you're trading commodities, stocks, or anything, right, that sudden move that you see on your chart to the upside or to the downside, that is primarily due to some big news, which news release. And usually, the move is so sudden and then it's so sharp that before these big publications like CNBC, Bloomberg, and so on and so forth, where, by the way, we do contribute on a weekly basis, before they'll put out the full story, it will be too late because the move would have already happened, and you won't be able to find a more informed decision based on what the news is. So if you are on Twitter, it makes things a lot more easier for you guys to understand and digest that news. So, I'm very active on Twitter. I tweet quite a lot, various different trends and cycles. So, this is your opportunity to get involved on Twitter and then ask me if you have any questions, and I'll be very happy to return. And I'll show you the Twitter handles for my Twitter account, and also for EverTrade's Twitter account as well. And secondly, what I wanted to discuss is the 2 videos that we do on a daily basis for our clients. So firstly, we have our fundamental videos. The fundamental videos are discussing the general themes that are likely to move the markets, and I'll show you one of them in a short in a short period. So basically today, as all of you know, it is the FOMC day. So what we really wanted to look at is how the FOMC is really going to move the markets, which asset prices, which derivatives, how much of that move can happen, or possibly it can happen. So we cover all of that sort of aspect in our fundamental video. Now, on the second side, what we have is something a little bit more advanced version of this one, in which we discuss about technical analysis. In this technical analysis, we look at the specific strategies which are likely to produce more positive results for our trading. So basically, what does that mean with respect to support and resistance level? What is a support level? What is a resistance level? How to trade around them. So that is a sort of a conversation, is really what we are talking about in these technical videos. So that's what we do. Does that make sense to you guys so far? So let me show you guys now how to find them and then where to go about them. So first of all, in terms of Twitter, so if you are looking to follow, so this is my Twitter handle, which is right in front of you, Naeem Hassan 23. You can see that I'm fairly very active with my Twitter account. I post quite a lot of stuff on a daily basis, so it is quite an interesting one for you guys if you really kind of wanted to know. And then for EverTrade, the Twitter account. Uh, so in order to find, or I'm just going to give you an example. So all we're going to do is go to Explore and type over here, EverTrade. So you see the first one right over there is EverTrade, and the major that the one that you are following is verified, because we are verified on Twitter. So over here again, you see all the various different tweets, the price levels with respect to that, and then again the videos of me talking and discussing about the markets. So everything is quite an intriguing one. So in terms of our YouTube channel, here is the opportunity. So what you see is on a YouTube opportunity is the videos on a daily basis. So, as you can see over here, that today is the FOMC day, so we talk about a lot more detail about the FOMC, what to trade on the back of that, and then how much of that movement is really likely to happen. So go and have a look on that. And in addition to that, we also have a crude oil video going up as well, where we're talking about, because crude inventory data is due at 3:30 British Standard Time, BST. So we also talked about that. So that is quite an intriguing one. So it's really, again, letting you guys know that, okay, what to do, and then where exactly to find all that information. So let's go back to our agenda, and then let's have a look at what we're really going to talk about from here. Now, let me go back to it. So the agenda for today is why to trade indices, the inverse of indices, the fund flow, defining levels, and defining a strategy. So that is pretty much what we are going to discuss today. And also we will have an opportunity, a little bit of an opportunity, to look at the live price action, the live trading that we will do at 1:30 p.m. London time. We are going to get the US retail sales number, and this number is likely to move prices quite a lot today. So we will have a look if we do have the time in relation to that. Now, why do we trade indices? The first question. The reason that we trade indices is primarily because if you have a small portfolio and in that portfolio, you have maybe 500 or 1,000 or 10,000, well, not really 10,000, I said, or a couple of thousands, then you cannot trade so many stocks. For instance, Tesla stock, for example, before the split, it was about $2,000. So all what you be able to do is just like buy one Tesla stock and just sit on it. Or Amazon. It's a massive price action for that. It's again very big stock on that, very big price on it. So you can't really do with a small portfolio. So in order to get an exposure to a large number of tech companies and other sectors, the best strategy perhaps is to trade the index. Because when you trade the S&P 500 index, my friends, you are trading the top 500 American stocks. So that gives you a very much huge diversification in terms of your stocks, because you're not only trading S&P 500 index, you have an exposure to all the top 500 companies. Similarly, when you are trading the Dow Jones index, you are not only trading one stock, but you are trading the top 30 Dow Jones stocks. And the same goes for the NASDAQ 100 index as well. By trading the index, you are trading all the top 100 tech stocks, which are part of the NASDAQ index. Now, another important thing when it comes to indices is that the amount of movement to the upside or to the downside is quite significant in comparison to one particular stock, because an index such as the Dow Jones index can move anywhere between 300 to 1,500 points a day. The 1,500 mark doesn't really happen that often, but it has it happened during this pandemic period. But the usual trading range for the Dow Jones index is between $300, so 300 points, not sorry, dollar 300 points. So that is a pretty big range. So it gives you a lot more opportunities with respect to the support and with respect to your resistance levels. The second thing that we look at is inverse of indices. So like if you are going long on S&P, then there is an index which really, if the S&P moves higher, the inverse index is something which moves in the opposite direction, meaning it moves lower. A lot of investors use these inverse indices to hedge their bets because they don't want it to be caught wrong on the market. So, if they're losing money on one, they're gaining money on the other side. But they usually do that under circumstances where they really need to put a hedge on a simple. So basically, they wanted to diversify it even more. The fund flow is something, one of the most famous and traded ETF is the S&P 500 index ETF called SPDR SPY, or Nasdaq's composite index called QQQ. So by looking at the fund flow, it gives us an indication whether large institutions are buying in or either they are selling out of those positions. So by doing that, what it does is it gives us a clear indication whether the upward trend is likely to continue and if it is supported by big money or smart money, or aka also known as the institutional money. So that is quite an important one. So let's have a look. Let's go back and have a look at the price action, the MT4. So as many of you know, you can pretty much download MT4 from anywhere, and also from our website evertrade.com. So now what we're going to do is we're going to have a quick review of major US indices, the one that we've talked about, and we will talk about the strategy behind it, how to trade perhaps those index, where are those potential support and resistance zones are. Is everything clear so far? Any questions? So just type the question straight away if you have any. Okay, so let's continue. People are pretty much talking about that they're very clear so far with respect to what we talked about. All right, so that's really good. So let's continue from here, and let's have a look at the index and the price action within the index and what exactly it means. Now, when we look at the Dow Jones index, my friends, so what we really mean by that in terms of the price action is we always begin by looking at the daily time frame and the daily time frame only. The reason is the daily time frame gives us a very good indication of the overall trend, because we are not looking on an intraday on a very small picture where things are a lot more choppier than usually they are, and we are not looking on a much bigger time frame like your weekly or a monthly time frame where things are a lot more smoother and there is not much movement there as well. So this kind of gives us a very good, very good sort of a medium view in between them, the way the market is really heading. And another way of determining that where the market is really heading, whether the market is going up or the market is going down, is by looking at the moving averages. So the three different moving averages that we have on our chart in front of you guys is 50-day simple moving average, which is in pink. Followed by that is your 200-day simple moving average, 100-day moving average, and finally your 200-day moving average. Now, if you wanted to put these moving averages all on your chart, all what you got to do is go to Insert, go to Indicators, go to Trends, and then click on Moving Average. So when you are on a moving average, so from here, as you can see, this is 200 and the color is green. So this is representing this one. If you wanted to change it, so you will just physically change the number here from 200 to 100 and then change the color to amber, or sorry, to orange. And then similarly for 50, you will change it from here to 50 and then change it to pink. Now the method, there are always few methods of calculating the simple moving averages. For the sake of simplicity and for this webinar, you just may want to focus on simple moving average, especially on the daily time frame. The reason for that is that it is a bit more smoother, less choppier, again, bit of in the middle of a road sort of approach with respect to that. So now you know how to put your moving averages. Now, in order to trade in relation to these moving averages, the strategy is very simple. When the price breaks above the moving average, that is when you go long. When the price breaks below the moving average, any of the moving average, then you go short. So by looking at the chart, the daily chart for the Dow Jones index, one can say that when the price broke below the 50-day moving average earlier this year, that was a very good indication for markets that, okay, look, things are about to turn sour. And another indication came when the price broke below its 100-day moving average, because at the time when the price continued to stay below that, it was a clear cut indication that this price is going to go towards its 200-day moving average. And then that is what exactly happened. The price went below that 200-day moving average, and then it came back up. When it came back up, many investors at the time would have looked at this index and then thinking that, look, you know what, we can actually go long because the index is coming back. But because the index failed to jump above the 200-day moving average, so that was the biggest signal for us that this is gonna go down and gonna go down hard. And that is what exactly it happened. Now, if we flip the things, literally turn things upside down, and we look at on the other side of the equation, when the price crossed above its 50-day moving average, it was the first indication that, look, things are about to get better. We had a retest of this same level over here, retest of the 50-day moving average. The price went back up and it broke above its 100-day simple moving average. So when the price broke above its 100-day moving average, that was a clear indication that this price level is going to change. This battle has changed its gear. Now it is moving into a higher gear. And then that is what exactly happened. The market continued to move higher to the upside. And then again, in June, the price fell below the 200-day moving average, indicating that, look, things are cooling off. So, you know, that the trade is to the downside from here onwards. And remember that at this particular time, when the price came here, as you can see, let me just draw that. So at this particular time, the price was very much in line with its previous resistance right over here. So if we draw that resistance right over here, oh, that it wasn't really a good one. So let me erase that. And so I'm talking about this right over here. So when this happened, it was pretty much clear that, look, the double top is pretty much forming over here, the first top being over here, and the second top being over here. So it was pretty much clear that, look, you know, things are running a little bit too hard. The price was trading way away from its 50-day moving average, because 50-day moving average was right over here. The price was here, retracement was due. And guess what happened after that? This is what exactly happened. The price moved back towards its 50-day simple moving average right over here. And then, my friend, again, we had a retest of the same level right at this point, touching this area, and then another retest over here, and the price continued to move higher from here. So the question really is that, okay, that is all good, but where do we go from here? Are we going to the upside or are we going to the downside? So that is the question for among investors and traders with respect to the Dow Jones Index. Now, before we answer that, let's have a look at okay. Let's have a look at why is it not letting me? Sorry, give me one sec. I'm just having a bit of a issue. So let's have a look at the Nasdaq index first of all, and perform similar sort of analysis. You know, this is what really happened right over here. As you can see, that the price crossed below its 50-day moving average, and then it went below the 200-day moving average, and then it went below the 200-day moving average. And then the price kind of came back right over here. The price came back over here, and then after that it went back and then went back below. And but now, after the reversal happened, price moved above its 50-day, it moved above its 200-day, it moved above its 100-day, and ever since the price has been trading to the upside, very strong moves. But now, right over here, this is where the price action becomes very interesting, and this is where we are going to have a further discussion on this. Now, one thing that we all know in relation to the Nasdaq index is that Nasdaq index has been the leading index, my folks. Why? Because this entire tech rally has been led by this entire coronavirus stock market rally has been led by a by tech sector. And given the fact that the price was trading over here, the price traded for a long time just below its 50-day moving average. This was very, very concerning for me right over here, because I wanted the price to do this, what it is doing now, moving to the upside, moving to the upside. That's what I wanted to do, wanted to see, that the price needs to do that, but it wasn't doing it. But now the fact that it has done it, so it is making me a lot more comfortable. Again, this 50-day moving average, which is right over here, it is going to continue to move to like that, somewhere around it. But as long as the price is staying above this moving average, this 50-day moving average, which is right over here, I think the chances are that we will stay in control of the price. The chances are that we will remain long. Markets will continue to buy. But if for some reason, if the price starts to roll over and then breaks below to this moving average and then it starts to go down, then we are looking at the next level of support, which is right near 100-day moving average. And after that, it is going to be your 200-day moving average. Now, in order to find the good level of support and resistance in the light of what we've just said, all what we got to do is look towards the left with 100-day moving average. So 100-day moving average is over here, and we're looking over here. So I think this is the potential first sort of area before we fine tune it. This is the first area of support that I'm really looking at in terms of a price action if it does remove. So I'm really encompassing this particular candle if the price breaks below that, because I wanted to leave a little bit of a room for myself in case the price starts to act a little bit abnormal. Similarly, when it comes to the next support area, the next support area for me, it is going to be is just right over here near its 200-day moving average. Right over here, I think this is where the bigger chances are. We can fine tune it by bringing a little bit more to the top side, or maybe just bring a little bit to the downside, because I think this support zone is going to become. So we're just targeting a bit of a wick of this candle and the near close of this open of this candle. That is what we are really looking at in terms of our next support. So this is support 1, this is your support 2, and this is your immediate support. This area, it makes everything in terms of a market, because as long as the price stays above this particular moving average, then we are okay, my friend. We have nothing to worry about. I think the price will continue to consolidate and then move higher from here. So that is more likely the chances are going to be with respect to that. Now, similarly, if we go on to our S&P 500, okay, but we have to stop because the data is about to come. So that means that we need to be ready. So over here, what you see is the news coming straight away. So I'm just going to get ready and I'm going to show you guys that what exactly we do with respect to that, and then we will see the huge reaction also coming for the euro dollar and for sterling as well. So for the Dow Jones, I'm going to change it to 5-minute time frame. I'm going to see how the reaction is going to be for just a euro dollar. Yeah, let's just say for euro dollar. Again, we're going to change it to a 15-minute time frame and then see how big the reaction is going to be. The numbers are going to be out any minute, and then as the numbers will come, I will tweet these numbers to you guys straight away right over here so that you guys get that data. So let's just wait for another minute or so, and then we're going to keep a very, very close eye on this as well. There you go. Numbers are out, and then the movement is happening. And it seems like that the number is slightly better than the expectations because it is moving to the upside. There, the numbers are out, and the U.S. commerce retail is going very, very fast. The retail sales, there you go. 0.7%, folks. 0.7% is the number, which is a pretty decent number, pretty much in line with the market expectations. And then we will also put this number over here as well, excluding gas and all of that. And now we should have the final number from Bloomberg as well right over here. So that increases 0.6%. So this is what I do for you guys. We push them straight out to you so that you have the opportunity to learn. And now, because the number wasn't really that much off, but it was a still pretty good number, we're seeing movement in euro dollar to the upside. Is there an opportunity right over here? Perhaps not. The opportunity on a 30-minute time frame. If we're trading on a smaller time frame, we have to look at a 30-minute time frame. The immediate support is going to be just over here. Resistance is going to be just over here. So let's see how the market, if the market comes to that, and the immediate support is going to be just over here, 1.186. So there's no opportunity here. Let's have a look at the Dow Jones. Dow Jones futures are started to move lower. Where is the opportunity in terms of a 30-minute? In terms of a 30-minute, we are looking at where the 50-day moving average is, because the market has started to roll over. We can see that the market has failed to break above this particular trend line. We have a very much of a symmetrical triangle also formed right over here. In terms of a price action, this is where we're going to look for an entry to trade. This is the breakout trade if it breaks to the upside. So again, there's no specific opportunity. With respect to gold, gold is something again we can look at very quickly. Nice pop to the upside. That is nice. I like that. You can see there's a big moves. 15-minute time frame shows a very decent move as well. 30-minute time frame is gonna be this resistance zone. The break of this resistance zone is gonna be a breakout trade the moment it breaks out of that. So that would be the trade for us in terms of that. All right, folks. So I suppose that is all for today. And if you guys wanted to know that, or so you guys wanted to know the Twitter handle again. So here is the Twitter handle, folks, right over here. So feel free to go on to that. So I'll say goodbye to you guys, and I'll see you guys next week, same place, same time. Bye-bye.